Nobody knows what the future's really going to do in some respects.
Yeah, look, I've always been a believer that the bricks and mortar experience is here to stay.
Welcome to this week's Escape Your Limits podcast. My guest today is the founder of a boutique financial advisory firm, an early stage investor in the health, active lifestyle, and outdoor sector. He is also an author, former investment banker, and co-founder of Iron Planet, a notable B2B auction site for used equipment that he sold for $758 million. As many of you know, the pandemic took the health and wellness sector mainstream and made the industry an increasingly attractive target for venture capitalists. For anyone interested in knowing more about where the smart money is going, then my guest today is the go-to authority. In our interview, we discuss the latest investment trends within the health, fitness, and wellness ecosystem, the way brands like Peloton have shaped what investors are looking for, how entrepreneurs can ensure they are picking the right investors for their startups, and what are the do's and don'ts when it comes to getting acquired. So please welcome the founder of Integrity Squared, Mr. Pete Moore, to this week's Escape Your Limits podcast.
Pete Moore, thank you for joining us on the Escape Fitness podcast.
Great to be here and great to be outside with you.
Yeah, we had, this is our, just for those who are listening, we attempted to do a virtual one, and technology didn't support us, and you happened to be in Santa Barbara. So
just randomly in Santa Barbara, so here we are. We might as well do this in person. It's my first one in person, so
right,
it's good to be back.
Yeah, and you've got a podcast, 200 episodes.
Yeah, called Halo Talks, HALO, which stands for Health, Active Lifestyle, Outdoors. So we're trying to broaden the scope of what we're doing.
Right. So tell us a little bit about Halo. So what's kind of outside of being a podcast host? What's your main business?
Yeah, I guess my day job is I am an investment banker. So my firm called Integrity Square. Professionals there. We've been doing transactions since August of 1999 in the health club industry. I used to work for the private equity fund that bought Gold's Gym back in that time with the Galliani brothers. Helped them build some more locations, acquire some locations, help start up goldsgym.com to bring the first dose of technology into the industry. And over the last, I'd say about 14 years, have helped probably about 100 groups bring in capital or complete diligence or make acquisitions or sell their businesses. Mm.
So it must be an interesting space, because I guess you're kind of predicting on the future, and I suppose how's that been over the last sort of couple of years, where nobody knows what the future's really going to do in some respects?
Yeah, look, I've always been a believer that the bricks and mortar experience is here to stay. You know, if you think about the Keurig machine, the Keurig machine, what's where that? The K-cups that go in the in your home coffee machine.
Oh, okay, yeah.
They said, okay, the Keurig machine was gonna, destroy the coffee houses, of the United States, which, has just made people drink more coffee. Yeah. So hopefully this addition of connected fitness and digital and everything else that's going to come forward, whether that's, holograms, whether that's, people actually inside of your, virtual room doing any kind of exercises. There's got to be a physical place where humans can go. We're social animals. I don't see any reason why, you stay in your apartment, you order DoorDash, you watch Netflix, and you get on your Peloton or Echelon. I don't think that's a prescription for a happy and healthy lifestyle.
Mm. So we were chatting before about putting deals together and how much work and how long it takes to put deals together, and then how things can change quite rapidly. What's it been like over the last 2 years then? So I suppose if people that are investing in companies, how did they look at the Halo space? And then how did you see, if anything, that changed as we're sort of like in the middle of it and now coming out? Because I suppose what I've seen talking to a lot of businesses like you do, there's a lot of emotion. You kind of everybody suddenly, when the pandemic hit, everyone was talking about digital, these new models, and that was going to be the future. And then I suppose as people started to get more deep into it, it was like, okay, well, maybe that's not quite going to be there. So as an investor and someone who looks at different businesses and tries to bet on or help people decide where the future's going to go, how have you seen that change, and how much emotion's been in some of those decisions?
Sure. Well, look, when it comes down to private investors investing in the Halo sector, and we'll take Planet Fitness or Orange Theory as an example, it all comes down to what the unit economics of that business model are. When you take a look at the Planet Fitness financials, because they publish them because one, they're a public company, two, because they have a franchise disclosure document, so they give you all the information you need to know on what the special sauce is and how they run that business. You can't necessarily replicate that, but at least you can understand it. So as you see an average Planet Fitness doing $2.5 million of revenue and $700,000 of club level EBITDA, and that's been done consistently over 1,000 locations. Private equity views that as a very low labor cost, a very scalable model, backed by a public company with 25 different private equity groups building out the territories. That is kind of like the Southwest Airlines or the Red Roof Inn or the In-N-Out Burger, if you will, of like, I can replicate this model pretty much anywhere that has the amount of density, which now that density is even smaller than you'd think would be required. So look, Orange Theory's got a great unit economic model. They do over $100,000 in revenue per location versus the average studio concepts doing in the $30,000 per month. So you're going to see private equity gravitate towards those types of concepts. And then if there's any new kind of franchisor that's coming up, whether it's skincare products or workout recovery, there's groups that want to catch that trend and say, I can take you from Massage Envy as an example, which is the deal we worked on a long time ago, was at 100 locations. Can this become 1,000? And can I ride that multiple wave? Now, what happened during COVID, which was really interesting, is the health clubs used to always just have to fight with each other. We're going to compete on price. We're going to compete on amenities. We're going to compete on group exercise instructors. Once the health clubs were closed, you saw a significant amount of private capital, mostly venture capital, going into digital apps like Strava, as an example. In Mirror, the amount of money that was raised and taken in and grown by groups like Peloton. Those groups, if I was a fly or you were a fly on the room in the venture capital, they're like, hey, there's $35 billion worth of annual recurring revenue that's up for grabs. And the private and the venture capital guys are basically saying, hey, if you've got a digital scalable app, we will put money in for you to go acquire those health club members. Mm-hmm. So a lot of that investing was basically like a vulture venture investment to try and take away a lot of the recurring revenue in our industry.
Right.
So I think the balance of power is now going to turn back, absent some, exogenous things that we can't control, whether that's masks or mandates or vaccination cards. But I think, investors at large are going to continue to come back into highly profitable bricks and mortar multi-unit operators. And I'll take a bet that there'll be more people working out with their friends and in communities than thinking that that's something they should start doing 100%, out of their apartment.
Yeah, there seems to be an unlimited amount of these digital companies. You mentioned Peloton, Mirror. There's the Vault, and I guess with clubs closing down, it seems like a logical thing to say is like, okay, well, there's all this opportunity there. But do you think, in terms of kind of investment, it has probably, people have got a little bit emotional and carried away with this is going to be the next thing, and now they're kind of realizing, well, maybe it's more difficult to get people to pay that kind of money for there's thousands of apps out there now, isn't there?
Right. Well, look, there's really limited or no barriers to entry on a new fitness app. So you really have to have a deep brand loyalty that you've created over a very short period of time, which is hard to do. And then is that really sustainable? And then when you take a look at a lot of these apps, there's 100% attrition,
really?
Or 200% attrition per year. So it makes the health clubs, at 30 to 40 to 50% attrition, hey, we're not doing that badly versus these apps. But look, I think that one of the biggest issues is that people change what their motivations are, and behavior kind of lasts for, 120 days. I want to go hard and I'm going to go, play tennis. After that, I'm going to go join a gym and do a boot camp. I might take a couple of months where I do my own thing. So I don't think a lot of these apps are going to be able to maintain a client, whereas a health club or a multi-sport operator might be able to retain that member kind of through their life cycle, a roller coaster of things that they want to try. Because I don't know anyone who just says, this is what I've been doing for 30 years and like I haven't tried anything else. There's new interesting stuff doing.
Yeah.
And I think the health club should be in a place where they have the equipment, such as yours, and equipment that people don't have at their home, because strength training and flexibility and using equipment is going to get you far superior results,
Right.
than just working off your your rug in your 1-bedroom apartment in Manhattan. I don't know if that's our audience, but that could be.
Yeah. And what do you think about Peloton then? Like because they've kind of created this virtual community, and if you look at some of the stuff they put out, they seem to say that the retention is very, very high. I don't know how they're measuring that, whether it's accurate, but what are your thoughts on that? Are they just doing something different to all the other ones? Or?
Look, I've got nothing but respect for what they built. I mean, I think it was an amazing company that we're in the right place, clearly at the right time. But it was really built as an alternative. So, the CEO and founder of the business, basically started Peloton or saw the opportunity because he couldn't get into a Soul Cycle or flywheel class and didn't have the time to allocate. So it really came out of a personal frustration. And when COVID hit, good for them to be able to at least allow millions of people who missed what they were doing, to be able to survive through that psychologically and physically and mentally. So what they're doing now, it's going to be a question, I think, of whether they embrace the health clubs. I think with Precor acquisition, they have an opportunity to really leverage the brand loyalty and the relationships that are in the clubs, and maybe Peloton, Connected Fitness or Precor home equipment could get sold, maybe through the clubs and use them as a showroom, or as that's the retail store instead of at the mall. Maybe it should be at every health club that carries Peloton and Precor equipment. So I feel like just like Amazon Prime, has got lock boxes in health clubs now. The health club should be a destination, and it should be encouraged for people to be going, out of their homes and interacting with other people and getting their endorphins running, and instead of going to a club, nightclub, go to the health club.
Right. How are you seeing people's investment choices, or what people are looking for now as we're coming out of it? Are they, obviously we talked about that sort of rush to digital. Are people sort of now, is their confidence high back in bricks and mortar as an example? Because I suppose there's still a lot of uncertainty. If you look at now, we've got this new thing going on, and do you put a lot of money into an area where things may be locked down again? You spoke about New York, and now you need vaccines and all that kind of stuff.
Yeah. So we're working on 2 transactions where we're one group's in Florida and the other group's out of Texas. So I get to sleep a little at night thinking that those deals hopefully will go as planned. But look, for transactions that are happening in very blue states, if you will, it's very difficult to predict what levels of mandates could come out. And I don't think that there's going to be another PPP loan that's going to be available if there is something that comes out. Now in New York, you have to show mandatory entrance is related to whether you have a vaccination card. The employees of those clubs also need to have a vaccination card. This has turned political in a lot of different markets. So depending on what area you live in, it might not be a big deal because 85% of the people in Upper East Side of Manhattan are probably vaccinated. What is it in some other suburbs or some inner city markets where that mask mandate or that vaccination card mandate, I might not be able to have half my employees come to work, right? So what's the government doing at that point? Now the members who want to stay healthy now don't have access to the equipment and the place that will keep them healthy. So now their immunity will go down. They already don't have a vaccine. So now they're more likely to get seriously ill. So you can tell where I fall on this. I think this is about personal responsibility. I think if you have a vaccine, then you're going to get the virus still, but it's not going to hurt you or hurt you as much. So be cautious, but I don't see any reason why people shouldn't do transactions in the space right now, because I do think it's a 3 to 6 month trial period. The issue right now is what is a seller willing to value their business at when they knew that 18 months ago was worth, significantly higher than it is, as of today. So what we're trying to do is kind of bridge the gap between here's what the company was worth, here's what you think it's worth today. That's clearly going to move up a diagonal literally on a daily basis. So if you want to buy the company now, you have to pay us that bridge.
Right.
Whether that's in cash or whether that's in seller note or some kind of easily understood earn-out type of structure. So
if you're looking from a I'll deal with them separately, buyer and seller. So in terms of a buyer, what is it a good time to be buying then at the moment?
I mean, I think it's a good time to be buying because now it's an opportunity where there's more real estate that's available that you could move more locations into, where landlords are still very keen on trying to find a 10-year credit-worthy tenant. So that there's a lot of growth opportunity. I think there's more digital and data analytics that you could do in order to try and get the membership back that you had before. And I think anytime you build a platform and have a 5 to 7 year view, it's good to get in now when there isn't as much competition for the deals because there is a wait and see. There's kind of a, like once around the mall window shopping. That's kind of what's going on right now. So I want to see what you got. I want to track it. And then kind of once it gets ready to, no issues left and we're kind of at the end of the tunnel, then I want to be there to do the transaction. And what we're trying to do is say, hey, look, that's not that far away. Why don't you get in now? You'll have the chance to actually grow this business and, we don't have to wait 6 months and you continue to look because we're going to raise the price when there's no risk left in the deal.
So from a seller's perspective then, and I know they're obviously sort of conflicting with each other, but if you're selling, is it best to just, sit tight, tidy things up and wait or...
So I think there's a couple different factors. First factor is if you think that there's a tax change that's going to be significant to you, which hasn't been announced yet or voted on, I believe, and you need to get a transaction done before the end of this year, you should test out and see if you can get the price that you want because that taxable gain is going to be different to you and it could be material. Second thing is unless you have opportunities that you can go and do an acquisition or you've got 2 or 3 letters of intent, you really want to go build something because you think it's proactive and aggressive and helpful to the, protect your entire business and maybe grow it in a really interesting way because landlords want to give you some money and, but you don't want to over lever yourself. So if you have business opportunities that you think, within the next 6 months is going to materially change the way my business looks, then I would look to do a transaction. But if you're saying, hey, look, I got through the storm, if you could get me what I got, what the business was worth in February, I think it behooves you to just wait at least another 4 to 6 months. Because once it's partly sunny out, you're going to be in better shape and you don't have to talk about what happened with your business. You can talk about where your business is. Mm-hmm. And there's not a story or a trajectory that needs to be explained and then validated every 30 days from now until you close.
Thank you for supporting the Escape Your Limits podcast. If you're thinking about creating a unique and engaging fitness space to take your fitness to the next level, then we have you covered. Escape Fitness design and manufacture some of the most innovative, attractive, and durable functional training and free weight equipment used by many of the best trainers and fitness brands across the globe. As a valued listener, we are offering you a 10% discount off many of the products on our website. You can check out the full range by going to escapefitness.com and use the code dumbbell. That's escapefitness.com using the code dumbbell. That's it from me. Please enjoy the rest of this interview.
So what about I said access to capital? Is there a lot of money looking for a home at the moment? Is it a good time to be raising money at the moment or not?
Yeah, well, look, it's there is a lot of money out there. That money is not dumb money, so they all do their work and they want to make sure that they get a good deal and that they do their diligence. It really depends on what the opportunity you're presenting someone with and how healthy your current business is. So if you had $3 million of EBITDA, pre-COVID and you're at 2.8, and most of the recovery has kind of happened already, and you've got an acquisition you can make, or you want to sign some leases, but you don't want to do it without having an equity partner, yeah, that's fine. But if you're at 3 million pre-COVID and now you're at like 400,000, it's going to be a long talk and a long walk to get the valuation that you want, and for somebody to firmly believe that the business is going to get back there and that they'll pay you a fair price, and not be kind of strung along for a longer ride back to profitability.
Right. So what about companies that have had a tough time, probably smaller sized companies where they've had to fund rent and now they want to open and reinvest again? Is it, for that type of business, is it a good time for them to be, or safe time, I suppose, for them to be raising money to kind of stabilize their business for growth again? What would you do?
I mean, it depends what kind of business you're in. There's a lot of technology companies that are valued based on a multiple revenue. So their profitability is not important to their valuation. That's a different argument for a different podcast. But from a standpoint of looking at software as a service business, and you have a CRM or a data analytics, if the market is showing that it likes your product, then it's always a good time to be talking to investors if you're building that ARR on an annual basis. But if you're really if you feel in your gut that my business isn't I'm not comfortable kind of sharing what's really going on with my business right now, we're not even close to where I'm at stability. Half my employees, are basically, not here, and I haven't replaced them yet. You never really want to go into a capital discussion and be in an area of weakness. If there's anything, I would try and take out more and more government or SBA loans and just kind of get your house in order, because you really have, one time to show it right, and then you can start conversations and get to know people. But if you show somebody a broken house, and then you say, hey, it's kind of fixed, they don't need to see what it was before.
Right. In terms of the sort of fitness club space, do you see there being any value in combining, in terms of the value of your business, combining like a digital with the bricks and mortar? Because most of them are one or the other, and a lot of people have gone into that space. But as you say, that they value digital companies different to the regular ones. Does that partnership create more of an interesting company from an investment perspective?
So if you're talking about a health club chain, they should be using, IntelliVideo or Forte Fitness or Uscreen or one of the groups that do private label video on demand. The issue that you have, if you're a private equity held business and you're building out health clubs, you have debt on the business. So what you're trying to do is continuously build more locations to build more cash flow, which gives you more access to debt, or you pay down the debt over time, and that's how you create value. So for me to then take that business with those constraints and those rules around it and try and plug in hey, here's this $5 million digital money-losing business that one day is going to be worth $100 million. The people that invested in this bricks and mortar play and the debt providers purposely didn't invest in that digital company. They invested in your company. So you really have to keep those separate unless you're a very large entity. If like an Amazon or, I don't know, pick a large business that Disney, they can obviously do their digital and they can do their bricks and mortar. But if you're a small business, the math doesn't work to keep those as a combined business.
Right. So within the Halo space then, early investment opportunities now as we're coming out, are there any sort of categories or channels or demographics that you've seen are kind of early opportunities that probably weren't around? I guess things that you're not trying to keep secret. And
Yeah. Look, a couple of things that we got into that I think have a lot of legs. We're invested in a company called Higher Dose, which is an infrared technology where they do saunas, they do sauna wraps, yoga mats with crystals. There's going to be a lot more innovation coming out of that entire workout recovery, and whether that's skincare products, whether that's gels and lotions, whether that's technology where you put a hat on it, regenerate your brain. There's going to be really cool stuff that come out
What
of
do you call that
area.
space? Like it's a recovery space?
Yeah,
is
just
it?
I would say workout recovery and
Right.
like brain optimization or human, optimization. So there's going to be things that you'll see, like a Theragun and a Hyperice. 4 or 5 years ago when I was in San Diego, I saw these guys running around with these guns. I thought it was funny. I liked it, but I didn't think of it as an investment opportunity. Right now, everybody has one.
Yeah.
So I think anything related to, human optimization and workout recovery. And then the second one is I think there's going to be a big opportunity in the recruiting space to try and bring all these athletes into the Halo sector. There's a group that we work with called the Athlete Book, and it's basically trying to match up seniors in college that play for D1, D2, D3 schools, and then get them into jobs at Orange Theory, Planet Fitness, Lifetime, Escape, Peloton, whoever it is, because all these kids came from, playing on, organized teams. So
Right.
they can play on our teams, and they probably don't want to put a suit on after they've been putting uniforms on for their whole lives, which we basically provide uniforms as adults. So I see a lot of opportunity there. And then I think, the data analytics is just going to get better and better. So those would be the three areas.
Right. What are your thoughts on outdoor? As something certainly in this part of the world has become popular, but also in Europe as well. There's with fitness clubs and concepts going outdoor. Are you seeing anything interesting happening in that space?
Well, I mean, one of our friends at the Atlantic Club out in Central Jersey, they redid their entire outdoor area, brought in shipping containers, cut them open. You're doing group exercise outside. I was just at a club in LA that's got huge fields that they've turfed over for kids programming, and all these groups are putting in pickleball now.
Yeah. What's that about?
Yeah, so I'm still playing tennis, but I think a lot more health clubs should start when they look at new locations. I think you go to the landlord and maybe take over some of the parking lot space and say, hey, this area is our outdoor space. It's also kind of like, in real estate terms, we call it an out parcel. Maybe there's an outdoor out parcel, and I've got the health club here, and I got my outdoor like on the front road or something. So I think there's going to be a lot more of that. And I just think people are going to want to be more outside more. So if you can offer that, I think the multi-sport operators are going to benefit over the next couple of years if they, one, raise their price, two, understand that the families that go to them are probably not going on these exotic trips for the next couple of years because they just can't calibrate, the safety risk. The big box health clubs should benefit from that, behavioral shift for a period of time.
All right. You mentioned price. So where do you see that going? Obviously, everything's getting more expensive. We've just been with a friend of both of ours talking about it, and equipment's going up, building these locations are going up. Obviously, there's a squeeze in the middle, but do you see the price going up and the value needing to go up with that? I'm talking specifically about the health and fitness club market.
Yeah. Look, I think a lot of health club operators, unfortunately, have been brainwashed into, competing on price. And we compete on price only against each other. If you're in New York City and you could go to a health club for like $19 a month, but your, turkey wrap costs $12, like that. I know the business works at 19. I get that the rents work at that price, but it kind of brings down the entire industry to the point where the only way the industry can kind of go back up is if like the bottom comes up with it, which I don't know if it will ever in this industry. So I think people need to kind of start to say, all right, what are people coming here for? What people do I want here? And, what price makes sense based on the amount of people I want to have. So if you have a 20,000 square foot, let's use it bigger. If I have a 50,000 square foot multi-sport box, in a suburb, I should probably have about 5,000 members in that. And then let's do the math to figure out, how much that price point should be. It should probably be, $100 a month. And what kind of value do I need to bring? Well, the first thing is that if I can just get people results and have fun, that I just accomplished, most of the goal. So I think people need to understand the relationship they have, the group exercise instructors, who are the important people in their membership base, and really cater to it as if you're running a community center for profit. And don't be afraid to ask for more money if you're delivering.
Yeah. I was reading quite a bit recently in terms of the demographic, and I don't know whether this is anything that you are able to comment on, but certainly a lot of the traditional fitness market is catered more for the younger audience, up to probably 30, 35. And I was reading some early statements from Peloton where they were talking about really they're going after the 35 plus, so older market. And this was pre-pandemic. Do you see any sort of demographic changes or opportunities where, maybe I was talking to Angel from Golds just earlier, and he was also saying about the older over 35s are the ones that are slower to come back. So are you seeing any trends in that side of things at all?
There's been a couple of concepts that have been started over the last 20 years where, it's going to be like a silver Fox Fitness or, silver something or other, or 50 and up fitness. And quite frankly, I think people that take really good care of themselves, don't want to really put themselves in that category until they have to, right? So I want to go if I want to go into a health club and I want to listen to hip hop music and I want to, sweat, it shouldn't matter what my age is. So, having said that, yeah, if you're a big box operator and you've got that type of demographic and you want to cater to that demographic, figure out what their specific needs are. There's probably, community, it's probably low impact group exercise. It's probably, health assessments or some kind of, body fat and flexibility like the TRX, map so you can, make sure you don't fall down. Those are some things that you could cater to it, but I would not advise somebody setting up a separate area or dedicate a separate club to that.
Right, okay. What about in-home? Which again, there's been a pendulum swing on that. Suddenly everybody was ordering tons of stuff, including the manufacturers for home. It seems as though that's kind of dropped off. A lot of people I speak to now have got probably too much inventory in that area and trying to get rid of stuff, and the prices are coming down. Where do you see in home? There's certainly, I feel myself, there's certainly been a change where people are now considering having a place where they can work out at home where maybe they didn't do before. But are you seeing any trends in that? And also in terms of investment, are people still looking to invest in sort of these at-home concepts which seem to be popping up all over the place?
Yeah, look, there's been several big venture capital investments over the last couple weeks. One in an app that's called OBE Fitness, Hydro, which is a rowing machine. I think one or two of a boxing at-home connected fitness device. Look, our goal with our whole Halo, mantra here is, anything you can do to solve loneliness, diabetes, and obesity, I'm all for it. So I think that's great. And if we can get people working out more and more, I just feel like we shouldn't allow people to just think that that's their sole solution, because I think they're going to lose some of the camaraderie that they have. They're going to lose a social element to what they're doing, and who their friends are, and different people they meet, and maybe have more appreciation for other people, in their communities. But digital fitness will be here to stay. I don't know if every kid getting up, who's 10 years old right now, 15 years from now is going to go and hop on their, at-home bike or at-home rower. We shall see. I think there's more and more people that are yearning to be outdoors, and all the sports that are going on outdoors, and whether that's beach volleyball or after watching the Olympics, sports I didn't even know.
Yeah.
Some of these rowing and canoeing events and so on and so forth. So I'm bullish on people getting healthier.
Yeah.
I think connected fitness is a great outlet, and it should be in every home. Human behavior is I need motivation, and I don't know if that motivation ever just comes from a watch or comes from a connected device. I think it comes from each other.
Right. So with people looking, maybe, I know at the moment there seems to be people who've got money from different sources, and maybe they've had enough of working for a company and they're like, okay, I'm into this fitness space, I want to set up a company. Are there any sort of startup tips for people in terms of what would make a good solid model where if they wanted to raise some capital, particularly now, would would have some of the right ingredients to, for them to kind of build a business around it? I know it's a very difficult question, but just in general, are there a few things that people should look at based on your experience?
I'll answer the question this way, because I don't have any exact areas, but the best businesses that I've ever been around or ever seen come out of a real frustration. And if there's no frustration, there's no business. So people have come into us in the past and said, I got this great idea. It's going to be aerial yoga, on a spin bike, with lights flashing, in a air conditioned environment. I'm like, why? What's the frustration you're solving? Because I know I don't need to be on aerial yoga and do the bike, and it's not something I think I need, right? So if it's something you think you needed and you got it, and then 10,000 other people got it, okay, let's have a conversation. Maybe there's something, in there. But any business, a lot of software companies that are in our industry all came out of, health club operators who were pissed that they couldn't do what they wanted to do. So they started writing their own code, or they got someone to write their own code, and now several of them are billion-dollar companies. Some of the CRM businesses were health club operators who said, you know what, the software that's out there right now doesn't do what I need it to do, and it's causing me a lot of frustration, and I'm losing money. So let me go and build it, or let me go find someone to build it. So I think everything's got to start with a frustration that's in the market, figure out if other people have it, then figure out how big that would be if everyone was fixed or solved using your software, and then go out and test it and then raise money after.
Yeah. So do you think in a lot of cases then, when people are looking for this greatest idea that's never been imagined before, have you seen that a lot of the successful concepts are based on things that have been around, but they've just delivered it in a better way?
I mean, that's a good question. I think technology is always, the king. But, if you said, Planet Fitness as an example, they stumbled upon Planet Fitness, because they had a failing health club. And they said, you know what, like this juice bar, we don't want to make any money. Get rid of it. These personal trainers, they're taking money from our clients. They're taking up all the space. Let's get those guys out. Group exercise instructors, pain in the ass to deal with, let's get them out, right? So they end up creating, Planet Fitness business model basically out of frustration and desperation. Now, if you and I sat down 30 years ago and said, hey, why don't we just craft up, what does the industry need? A self-serve laundromat, right? There's laundromats on every street corner, in every suburb, right? So why didn't we think of that, right? Because we didn't get to that point that was the business model, because we didn't know that's what really, that it worked. So the Planet Fitness guys proved that works.
Right. So for people that are starting and they need to raise money, like I listened to your story when you started Iron Planet, and apparently you kind of had a bunch of credit cards where you were able to sort of, I don't know whether I can say that or
Fitness
not.
Insight. Yeah, no, talk about it. No, I mean, you just get a credit card in the mail every week, and it's like, back then there was no Amazon Web Services, right? So you paid $10,000 a month, and you had a couple of server racks, and there was a guy named Thomas who worked for me who was 24, probably had a drinking problem, and when the servers went down, he would have to go to the AT&T data center, literally go in, check in with his badge, and then reset the server, and goldsgym.com would turn back on. So back in the day, the one thing that they didn't teach you in business school is when do you know to fail? When do you know to say hey, this isn't working? And I think you come out of school and you think, hey, this is my first idea. It's big. I know it's going to be big, but the market wasn't ready for it. So, me going around trying to get health club operators to do online fitness nutrition programs, it's kind of ironic. We're talking about it now in 2021 and maybe happening. In 2000, I'd run around like a lunatic around the United States trying to get people to get their internet leads from the goldsgym.com site, upload their personal trainers, fitness nutrition programs, and we sold these cardboard cards for $1.99, and they sold them for $34.99. But when AT&T said, hey, we're turning the servers off tomorrow, you don't have any money left, you use one of the credit cards that was in the mail. So, because I didn't want to fail, because it was personal.
Right. And is that sort of a good way? Is that something, a way to start? Because I guess if most people, it's not easy to raise money, and
Look, I'm not an advocate for people like leveraging up credit cards. But the point is, like, you got to start small.
Right.
And, try not to do it on your own. That's one of the takeaways I've had from some good mentors of mine, said, if you're going to do a business, just make sure you got a couple partners, because it gets really lonely when you're running your own company.
Right.
But, raising money, once you have something, go and raise, small amount of money, then test it. There used to be a Series A investment, B, C, D, E. It was basically, okay, here's my Series A experiment. Can you fund this experiment? If it works, then I'll give you money for the next experiment, and so on and so forth. So that's what the letters used to mean. Now the letters are just massive amounts of capital. They're getting put into a company to try and grow the revenue and try and get it to an IPO, and an ultimate exit.
Right.
But it's not as much of an experiment. It's more of like a scaling operation.
Okay. So outside of coming to someone like you, if someone is looking for an investor, then what are they? What's the kind of some of the important things that you got to get in place? Like, my guess is getting your numbers right is a big one. But what are some of those things that probably people really need to spend the time on before they start talking to someone like that?
Yeah. So look, I mean, if it's a company that's got a product and they're looking to scale the product, I think you just got to start showing somebody, here's how good my marketing is. Every time I spend X dollars of marketing, it gets me X number of sales. So if you want someone to then fund, that formula, that's one way to raise capital. If you're if you see a big opportunity in the market and you've got some strong clients that'll become good references for investors, you could go put materials together. There's venture capital firms typically like to deal directly with an entrepreneur. It's a lot of work, but you get the local venture capital list, and you make calls and you send emails out, and you go to networking events, and you try and go on LinkedIn and find who do I know at this firm that might want to take a call. And most of these venture firms are looking at total addressable market. So how big can this company be?
Right. And what are things typically that people get wrong when they go to look for investment?
One, they start to get fixated on what their company is worth before they have a conversation about to help someone understand what their business is. So we have groups that might come in and say, I think my company's worth 50 million for no reason. And I want to go and raise 20. I'm like, all right, well, instead of thinking it's worth 50, why don't we put the materials together, see what the returns look like, see how we would risk adjust it if we were the ones putting the money in, and then let's go out and talk to people and see if they agree with what the future looks like. So that's how we kind of started our conversation. So if you get to the right investor that believes in connected fitness is going to be the next big thing. Peloton, yeah, they're great, and they're going to be great at this part, but you've identified something like, let's say, physical therapy or some kind of connected medical gear, and you've got a partnership with Apple, Samsung, and Medtronic, right? Okay, that sounds interesting. Now, you might have hit a venture capital firm at the right place at the right time when they're saying, hey, there's going to be a convergence between, medical fitness, connected fitness, and healthcare. And like, okay, that fits. So now we're going to fund that idea together.
Right. And when do they look at getting their returns from that? And I know there's different types of investment, but typically, are they looking to sort of put in some money and get a particular multiple out in a space of time, or are they? How does that work in terms of what the investor generally wants to get back from it?
Yeah, look, it typically was a 5 to 7 year hold period, is what a private equity fund would say. Venture firms, it could be, they could put money in and they could be out in 6 to 12 months. They could be out in 10 years. They could be out never. So typically the funds that most groups are going to work with raise money from pension funds, endowment funds, colleges, high net worth investors, and they basically ask for the money for a 10-year period. So over a 10-year period, we have $1 billion fund, and you have 10% of that, so you're committing $100 million to my fund. And then when we do a deal, we're going to send you a fax, or we're going to send you an email that says, we're funding this deal next Monday. By Friday, you have to have your 10% of this deal, funded, so we can fund the transaction. So it's typically a 10-year period. So you invest really heavily over the first 5, reserve some capital, and then try and build the companies and sell them, within the 10-year period.
Right. And what are they typically looking to get back on their capital then?
If it's a venture firm, they're looking for the home run, the next Uber or the next Google or DoorDash or what have you. But they typically generate, anywhere between 30 to 40% returns. But that's, money in today and then money out, in a long period of time. And then if you look back, it would have been 30 or 40% is what they would have made each year, right, on the internal rate of return. Private equity funds are more in like the 20s percent IRR. And then, if it's a debt fund, it could be anywhere between 6 to 12%.
Right. And do you use different types of companies depending on where your business is in its sort of lifespan?
Correct.
Right.
Yeah. So if you're early stage and you don't have any EBITDA or cash flow, you're going to be talking to venture firms or family offices. If you got, let's say, $3 million of EBITDA and higher, then you're going to be talking to growth equity funds. If it's over 10, it's probably private equity. And that's kind of how the trajectory flows.
Right. So a couple of questions then before we wrap up. So if people are interested in finding out more about this, how do you work and interact with people that are looking to raise funding or to grow their businesses?
Yeah. Well, first thing is we run something called a Halo Academy. So I run a 2-week kind of business school intensive where we go through Peloton, CrossFit, Soul Cycle, Cycle for Survival, and Planet Fitness as 5 case studies, business school case studies. So we're doing that again in October. Otherwise, you go to integritysq.com, contact me, contact Dave Ganelin. We're happy to get on the phone and, just give people a crash course or help out, see if it's something that we can be a good advisor on or try and get you to the right place. Our goal is just get as much capital into the space. If we do the deal, that's great. If we don't, doesn't matter. More people are out there, living a healthier lifestyle. And, we've kind of accomplished our goal, kind of like you, with your podcast. If somebody takes one takeaway from this and starts up or helps them build a better business, then hundreds of people, benefited. So
right,
that's what I like about what we're doing.
One of the things I was reading about is you have these personal KPIs. I thought it was interesting. Can you tell me about that?
Well, I just think, every day, you got to think whether you have a win or a loss. And I think a lot of us as entrepreneurs and A-type personalities think that, we've gone into the workforce, we're going to go 365-0 every year. And the reality is, if you kind of look at, if you looked at yourself as like a batter in a major league game, if you close 30% of every fastball that came down as a potential client, like you got a really big business right now. So stop focusing on, shoulda, coulda, woulda with those other 7, because now you're missing the next 3, and you're missing the next 10. And what you have to do with the 7 is really go through and find out, like, why didn't I win that account? Was it because, was it my preparation? Was it like I didn't understand what they wanted? Maybe it just wasn't a good fit. So I can kind of take them off the list, like they weren't a real prospect. But I think people need to like think of themselves more in like analytics. And then also, when you bitch about, your high school or your professional coach that, didn't, called the wrong play the other day, like think about how many wrong plays you call a day, and if you want to be critical of these NFL coaches, be as critical on yourself and see how many more results you get out of yourself. So I wrote this book called Time to Win Again. I'll get you a copy and you'll like it. It's kind of like a Where's Waldo meets Good to Great. So right. I think we're all professional athletes in our own respect. So I just want to kind of have all of us start operating like we are.
Where do you get that book if people are interested in it?
You just go to our site, probably the halotalks.com, and we'll have a little pop-up box and we'll be at Ursa. So
right.
It'll be fun. You'll like it.
So final question then. Escape Your Limits is about escaping what you believed is impossible and gone to make it possible. What would be an example of escaping your own personal limits?
So I'll tell you a quick story, which I told you before, but 3 years ago I went to train like a firefighter at the FDNY, and it was a very humbling experience because you go through different simulations on, going into a burning building, subway terrorist, event, and you realize that you got to work as a team. This is a much harder job. I got much more respect even though I had enough for firefighter, I really understood it. And they came up to us after this event and said, hey, we need fitness equipment for the fire departments. So I said, send me a list. And they sent me a list of 600 plus pieces of equipment. And over the last 3 years, we've gotten about $750,000 worth of equipment, that all of our clients that we've told about it now donates to the FDNY. And they made me a FDNY honorary fire chief 2 weeks ago. So that's something where I never thought that could ever happen to me. And it kind of it still feels kind of like an outer body experience. But when I met the guys there and these guys lined up, be like, hey man, thank you so much. I didn't realize how much I helped them because it wasn't about me and I didn't think about how much work it would be. I just did it. So you have the power to do a lot of things if you want to. And then if people notice, that's great. Even if they don't notice, it's still great. So.
Fantastic. Well, Pete, thank you very much for your time.
Man, great to see you, buddy.
Thank you.
Awesome.
Hey, I hope you enjoyed this podcast. If you did, then please go over to iTunes and subscribe to the Escape Your Limits podcast. Leave a review, leave a comment. It really would help us a lot to continue to keep these going.